Everybody asks the same question when they begin to take wealth seriously. Should I start with stocks or should I start with real estate? Whenever I hear that question, I usually ask a different question back. Why are you asking now? That is not a small question. It tells me a great deal about the person asking it. Most of the time, the question did not come from a calm analysis of their balance sheet. It came from exposure. They saw someone they know make money in stocks, or they saw someone buy a rental house and talk about cash flow, or they watched a video where someone made real estate sound easy. Suddenly, the thing that was always there becomes the only thing they can see. There is a name for that. It is called the Meinhof phenomenon, or frequency illusion. When your mind becomes aware of something, you start seeing it everywhere. The thing did not suddenly appear. Your attention changed. If you start thinking about buying a certain truck, you begin seeing that truck in every parking lot. The trucks were always there. Your brain had simply classified them as irrelevant before. Then, once they mattered to you, they became visible. Investing works the same way. That is why the order matters. The first investment you make is not just a financial decision, it is a decision about what your brain will begin to notice. It is the beginning of your learning machine. This is why for most beginners, I usually say start with stocks. Not because stocks are better than real estate in every condition. They are not because real estate is bad. It is not. I have great respect for real estate as a wealth building tool. It has cash flow, leverage, tax advantages, control, and long-term compounding power. But I also know what happens when people start in a place where one mistake can do too much damage. The goal in the beginning is not to look sophisticated. The goal is to build competence without being destroyed by your first mistake. That principle matters more than most people understand. The first time you buy shares in a company like Coca-Cola, something changes. You start noticing things you ignored before. You begin to care about earnings. You look at the dividend. You hear a report about consumer spending, and suddenly you realize it might connect to a company you own. You see a price-to-earnings ratio, and it stops being an abstract term from a finance video. It becomes relevant because your capital is attached to it. Skin in the game changes attention. Attention changes learning. Learning changes behavior. That is how competence is built. Not by passively watching 10 more videos, not by reading another online thread and thinking you have absorbed wisdom, not by listening to friends argue about what is hot. It comes from ownership, observation, feedback, and repetition. When you own something, the market teaches you. If you are humble enough to listen, you begin to see patterns. I have seen many people wait until they feel ready before they start. That is backwards. You do not become ready by thinking. You become ready by engaging at a level where the downside is survivable and the feedback is real. That is why stocks are such a useful starting point. They allow you to learn in small units. If you buy a stock and you are wrong, the value can go down. That is painful. But if you size it properly, it does not ruin you. You can study the mistake. You can understand whether the business weakened, whether valuation was too high, whether you were emotional, or whether the market simply moved against you for a while. The loss becomes tuition. Real estate is different. If you buy a rental property and you are wrong, the problem can become much more than a mark-to-market loss on a screen. A tenant can stop paying, a roof can fail, a property tax bill can jump, an air conditioning unit can die in the hottest month of the year, a legal problem can appear, a tenant can damage the place and refuse to leave. A property you thought was passive can become a full-time emotional burden. And if you put nearly all of your liquidity into that first deal, what should have been a lesson can become a financial wound. That is why sequence matters. People often confuse the question of where they should start with the question of where they should end. Those are different questions over time. A resilient wealth system usually has multiple buckets. You want income, producing stocks, you want real estate or real estate exposure, you want managed money or professionally allocated exposure, where not every decision depends on your own judgment. And you want cash or cash equivalents so that opportunities and emergencies do not force you into bad decisions. A useful model is the 30-30-30-10 structure. 1 part in income, producing stocks, 1 part in real estate, 1 part in managed money, broad funds, syndications, or other professionally structured exposure. And a final part in cash, gold, Bitcoin, or other cash equivalent dry powder, depending on your risk profile and the world you are trying to prepare for. The exact percentages are less important than the principle behind them. Do not become dependent on a single asset class, a single story, a single market, or a single form of liquidity. I have watched investors become rich on paper and fragile in reality. They owned one type of asset. Then the cycle turned. Housing fell. Stock sold off. Credit tightened. A tenant left. A lender changed terms. And suddenly what had looked like wealth became stress. That is not wealth done well. That is concentration pretending to be conviction. But in the beginning, if I were building the system from zero, I would still start with stocks. The first reason is liquidity. Liquidity is not a luxury for a beginner. It is protection. If you buy a stock today and you need the money 3 months from now, you can usually sell it and settle the cash. You may take a loss, you may have to admit you were early or wrong, but you can get out. If you buy a rental property today and need the money 3 months from now, the conversation changes. You may have to list it, you may have to accept a bad offer, you may have to pay commissions, you may have to repair it before selling, you may have to wait months, You may be forced to borrow against it. You may discover that what looked like equity is not nearly as liquid as you thought. Liquidity gives you margin for error. And when you are new, margin for error is essential. A small problem should not put you into panic. Panic destroys wealth because panic makes people convert temporary trouble into permanent loss. If you are illiquid, you can be forced to make bad decisions at exactly the wrong time. If you have liquidity, you can breathe, you can think, you can choose. The second reason is the learning curve. Many people believe real estate is easier because they can touch it. A house feels real, a stock feels abstract. But understanding what a house is and understanding real estate investing are not the same thing. A house is a physical asset, a real estate investment is a system of price, financing, rent, vacancy, maintenance, taxes, insurance, management, legal structure, tenant quality, local law, interest rates, capital expenditures, and exit value. If one of those pieces is wrong, the result changes. If several are wrong, the investment can hurt you. Stocks have their own complexity, but the mistakes are usually smaller when you begin properly. I am not talking about gambling in small speculative companies because someone online said they were about to explode. I am not talking about buying whatever your brother-in-law mentioned at the gym. I am talking about starting with quality businesses that already have durable cash flow and a long record of returning money to shareholders. Boring is often a very good teacher. A company that has paid and increased dividends for decades can teach you a lot. It teaches you what cash flow looks like. It teaches you what revenue stability looks like. It teaches you how valuation matters. It teaches you how an income stream grows slowly. It teaches you why discipline beats excitement. That is where I would begin. I would look at dividend aristocrats and dividend kings. These are companies that have paid and increased dividends for long periods of time. The point is not that they can never fail. All companies can fail. The point is that they give you a training ground. You can study businesses with operating histories. You can see how mature cash-generating companies behave across cycles. When I evaluate a stock as a starting point, I want to ask a few simple questions. Does it pay a dividend that is meaningful enough to matter? Has that dividend been consistent and growing? Is the stock price stable enough that I am not just trying to catch a falling knife? Does the company have options available so that an experienced investor can eventually learn additional ways to generate income from the same asset? Has the company maintained its dividend record for a long enough period to show discipline? Is revenue stable or growing? Is the valuation reasonable, or is the investor paying too much because the story is popular? Are analysts broadly constructive, or is the market warning that something may be wrong? You do not need to be an expert on day one. But once you own the stock, these questions stop being theory. They become live information. They begin to matter because you are no longer just observing the game. You have a small position on the board. That is how you build pattern recognition. And pattern recognition is one of the most valuable things an investor can develop. You begin to see that some stocks move in channels. You begin to notice what happens before earnings. You begin to see how the market reacts differently to revenue growth, margin compression, debt, guidance, dividends, and cash flow. You begin to understand that a stock is not a lottery ticket. It is a fractional ownership claim on a business that change in thinking is the real return. Early on, the money matters, of course, but the deeper value is becoming the kind of person who understands how money behaves. That is why I like the idea of becoming a stock market landlord before becoming a physical landlord. You learn to think in terms of cash flow. You learn to prefer eggs over chickens. You learn that the goal is not to eat the asset. The goal is to own assets that produce something while you still own them. In a stock, that can be dividends later. With more knowledge and appropriate risk controls, it can include option premiums, such as cash-secured puts and covered calls. You can be paid to potentially enter a stock. You can be paid while owning it through dividends. You can be paid by selling someone the right to buy it from you at a higher price. And if the stock appreciates, you may be paid again through capital gains. That does not mean the strategy is risk-free. Nothing is. It means the system teaches you to think like an owner of cash-flowing assets rather than a person chasing price movement. That mindset transfers well to real estate later. Not to be very clear, I am not anti-real estate. Real estate is one of the most powerful wealth building tools available when it is handled properly. The tax code often favors it. Depreciation can shelter income. Bonus depreciation can accelerate benefits in certain situations. Leverage can increase returns when it is used intelligently. A 1031 exchange can defer taxes step up and basis can have powerful estate consequences. A buy, borrow, die structure can preserve wealth across generations if planned correctly. Real estate has many advantages that stocks do not, but those advantages come with operating complexity. That is what beginners underestimate. They hear that real estate creates passive income. They do not hear about the tenant who stops paying. They hear that property appreciates. They do not hear about the market where the taxes reset, insurance doubles, and cash flow disappears. They hear about leverage. They do not hear that leverage cuts both ways. They hear that the tax code loves real estate. They do not hear that bad underwriting still loses money even when the tax treatment is favorable. The asset class is not the problem. Sequence and sizing are the problem. I have seen people save $20,000 or $30,000, watch a few videos, and decide they are ready to buy a cheap rental in a market they barely understand. Then the tenant does not pay. The air conditioner fails, the roof leaks, property taxes rise, they have no reserve. They cannot sell without taking a loss. They cannot borrow easily. Their entire cushion is trapped inside one problem. That is how beginners get hurt. The issue is not that the little house was bad forever. It might be part of a good portfolio if the investor owned several, had reserves, understood the market, and could absorb variability. But when one small property becomes your entire balance sheet, it is no longer an investment. It is a concentration risk with plumbing. That is why I would rather see a beginner first build liquidity, competence, and a cash flow mindset. Then move into real estate the smart way. There are ways to get real estate exposure without immediately jumping into the deep end. One way is house hacking. You buy a primary residence with extra rooms, or a duplex, triplex, or small multifamily property. You live in one part and rent out the other rooms or units. That gives you training wheels. You are learning landlord behavior, tenant management, maintenance, and financing. While also using the property as your home, it is not risk-free, but it can reduce the pressure because you are going to need a place to live anyway. The property is not purely speculative. It has utility. If the numbers work, the rental income can help cover the mortgage and give you experience. Another way is the live and improvement strategy. You buy a primary residence that needs work. Maybe it is dated, maybe it is ugly. Maybe it has deferred maintenance that you can handle gradually. You live in it for at least 2 years, improve it, and then potentially sell it. The reason the 2-year period matters is because under the primary residence exclusion rules, a single person may be able to exclude up to $250,000 of gain from federal taxes, and a married couple may be able to exclude up to $500,000 if the ownership and use requirements are met. The general idea is that if you live in the home for 2 of the last 5 years, there can be a large exclusion on gain. That is one of the great wealth building breaks in the tax code. You can improve the asset, get utility from living in it, build equity, and potentially sell without the same tax burden you would face on an ordinary investment property. Done a few times over a decade, that can build serious capital without starting with a traditional rental. Again, the principle is the same. Learn with a structure that gives you utility and reduces the chance that one mistake destroys you. Another way to begin real estate exposure is through REITs, real estate investment trusts. A REIT lets you own exposure to real estate with the liquidity of a stock. It is not the same as owning a rental house. It will not give you the same control. It will not teach you how to manage a tenant directly, but it can teach you how real estate behaves, how rents, interest rates, debt, property sectors, dividends, and market sentiment interact. For a person with limited capital, REITs can be a useful bridge. You can own public real estate exposure without tying all your liquidity into one property. You can study the financials. You can learn which sectors are sensitive to rates, which are sensitive to consumer behavior, and which are driven by long-term leases. That is a safer training ground than taking your first $30,000 and buying a distressed single-family house in a city you do not know because someone online made it sound easy. This is where I want people to be especially careful. The internet makes everything look simpler than it is. People who have never survived a cycle can sound very confident. Writers can publish articles about real estate without having operated real estate. Commentators can explain taxes without understanding tax law. AI can produce answers that sound authoritative and still be wrong. There is a cognitive bias related to this. When you read about a subject you know well, you can often see the errors immediately. You realize the article is oversimplified, you notice missing details, but then you turn the page to another subject you know less about and assume that article is accurate. That is dangerous. In investing, you need to know when you do not know. That is one of the most important principles in decision making. The risk is not ignorance. The risk is ignorance mixed with confidence. So before you buy real estate, you must know the numbers, not the promotional numbers. The real numbers. If a property rents for $1,500 a month, do not pretend you keep $1,500. You do not. Some of that rent goes to property taxes, some goes to insurance, some goes to repairs. Some goes to maintenance, some goes to management, some must be reserved for vacancy, some must be reserved for capital expenditures. A roof does not ask your permission before it ages. An air conditioner does not wait until your cash flow is convenient before it fails. A conservative investor may assume that roughly half of gross rent disappears before debt service. That is not a law. It varies by market and property, but it is a useful mental discipline because it prevents fantasy underwriting. If $1,500 comes in and $750 is the realistic net before debt service, then the debt service must be below that for the deal to have positive cash flow. If the math does not work, do not do the deal. Period. This sounds simple, but many people break this rule because they want the deal to work. Wanting is not underwriting. The deal does not care how badly you want to be a real estate investor. The market does not care that someone else made money. Your tenant does not care that you watched a motivational video. The numbers either work or they do not. That same principle applies to stocks. If valuation does not make sense, do not create a story to justify it. If the dividend is not supported by cash flow, do not call it income. If a company is declining, do not call it a bargain just because the price is lower. If you do not understand the source of return, do not size it as if you do. A good investor is not someone who is excited. A good investor is someone who can think in systems. Systems protect you from emotion. That is why the 30-30-30-10 framework is useful. It forces you to think beyond the asset that is currently popular. It reminds you that wealth should be built across buckets income. Producing stocks can teach you business ownership and give you liquidity. Real estate can give you hard asset exposure, tax advantages, and cash flow. When done well, managed money can reduce the burden of every decision depending on your own judgment. Cash and cash equivalents give you optionality. Optionality is powerful. A person with no cash is often forced to sell what they should hold. A person with cash can buy when others are forced to sell. A person with no liquidity sees volatility as danger. A person with liquidity can see volatility as opportunity. That is why the cash bucket is not something you fill last. You build it as you go. If you have $50,000 in stocks, it is wise to have cash or cash equivalents alongside it. If your portfolio grows to $1 million, you should still think about how much is in income, producing stocks, how much is in real estate or real estate equivalents, how much is managed outside your direct decision making, and how much is dry powder. The exact numbers may vary based on your age, income, taxes, goals, and risk tolerance. But the principle is stable. Do not become fragile. Fragility shows up when your entire plan depends on conditions staying favorable. When rates stay low, when tenants keep paying, when stocks keep going up, when nothing breaks. When your job remains secure, when lenders remain friendly, when liquidity remains available. That is not a plan, that is a wish. A good plan assumes that bad things will happen. It builds in room for them. It keeps you from being forced into desperate decisions. It allows you to keep playing, in investing. Surviving long enough to compound is more important than looking brilliant in a single year. That is another reason I like Stocks First for beginners. They can help you become competent while keeping you in the game. You can start small, you can study, you can observe, you can build habits, you can learn how cash flow, valuation, dividends, earnings, and market cycles interact. You can make mistakes without one mistake becoming catastrophic. Then when you move into real estate, you are not moving from fantasy. You are moving from a base of competence. You will know how to think about yield. You will know how to think about risk. You will know how to ask what can go wrong. You will know why liquidity matters. You will know that cash flow is not the same as gross revenue. You will know that the goal is not to impress people. The goal is to build a machine that pays you, protects you, and gives you control over your life. That is the deeper point. People get pulled into stocks or real estate because someone else is making money. That is not a good reason to invest. The right question is not, what is hot right now? The right question is, what stage am I in? What skills do I need to build? What risks can I afford? And what system will make me stronger over time? If you are on chapter 1, do not copy someone else's chapter 20. That mistake destroys people. You see someone with 20 rental units and think you should buy one immediately, but you do not see the years they spent learning markets, building reserves, hiring managers, making mistakes, surviving vacancies, and understanding financing. You see someone trading options and think the income looks attractive, but you do not see the risk controls, the experience, the losses, the psychology, and the years of pattern recognition. Copying the visible outcome without the invisible preparation is one of the most common errors in wealth building. The better path is slower but much stronger. Start where the downside is contained, build skill, build liquidity, build a system, then expand. If I were speaking to someone just beginning, I would say this as plainly as possible. Start with quality income, producing stocks, use them as your training ground. Learn what dividends are, learn how earnings work, learn how valuation works, learn what a strong balance sheet looks like, learn how management communicates, learn what happens when markets fall, learn whether you can stay calm. Then, once you have a base of capital and competence, begin moving into real estate intelligently. If your primary residence can help you learn through house hacking, study that. If a live-in improvement strategy fits your life and your market, study that. If you want exposure before direct ownership, study REITs. When you eventually buy a rental, underwrite it conservatively, assume repairs, assume vacancy, assume taxes and insurance rise, assume something goes wrong, then ask whether the deal still works. If it only works under perfect conditions, it does not work. If it requires optimism to survive, it is not a good deal. And as your capital grows, move toward balance. Do not let your identity become a single asset class. Do not become the stock person who mocks real estate. Do not become the real estate person who mocks stocks. Do not become the person who thinks cash is useless because it earns little. Do not become the person who thinks cash is safety while inflation quietly drains it. Each asset has a job. Stocks can provide liquidity, ownership, dividends, and exposure to business growth. Real estate can provide cash flow, tax advantages, leverage, and hard asset exposure. Managed money can provide diversification and reduce decision fatigue. Cash and cash equivalents can provide optionality, safety, and the ability to act when others cannot. The art is not choosing one forever. The art is sequencing them properly. The biggest financial mistakes often happen when people skip sequence. They want the advanced move before they understand the basic one. They want leverage before liquidity. They want tax strategy before cash flow. They want real estate before reserves. They want options income before understanding the underlying stock. They want the appearance of wealth before the structure of wealth. That is backwards. Wealth that lasts is built in layers. The first layer is competence. The second layer is liquidity. The third layer is cash flow. The fourth layer is diversification. The fifth layer is tax efficiency and asset protection. Most people try to start with the fifth layer because it sounds sophisticated. But if the first layer is weak, the whole structure is weak. This is why I do not get excited when someone tells me they found a great real estate deal before they can explain vacancy, maintenance, capex, insurance, property taxes, financing, tenant risk, and exit strategy. This is why I do not get excited when someone tells me they bought a stock before they can explain revenue, earnings, dividend safety, valuation, debt, and the source of future return. It is not enough to own something. You need to understand what you own. The market is a very expensive teacher when you refuse to do the homework. But it is a very good teacher when you start small, observe carefully, and build from principles. That is the approach I would take. Do not chase what looks hot. Do not panic because someone else is making money faster. Do not put all your capital into a move you do not fully understand. Do not let social proof become your investment thesis. Ask why you are asking now. If the answer is because you suddenly see everyone making money in one place, pause. That may be frequency illusion. Your attention changed, not necessarily the opportunity. Use that awareness instead of being controlled by it. If stocks have become relevant to you, begin there carefully. Buy quality, watch, learn, build competence. If real estate has become relevant to you, do not romanticize it. Study the numbers, understand the operational risk. Build reserves, use safer bridges if you need to, move into direct ownership when your capital, competence, and liquidity can support the mistakes that will eventually happen, because mistakes will happen. The objective is not to avoid every mistake. The objective is to make sure the mistakes are survivable. That is how you stay in the game long enough to compound. And if you stay in the game, if you keep learning, if you keep your risk controlled, if you build income, producing assets, and avoid concentration that can break you, you can build wealth that lasts, not because you copied someone else's hot move, not because you guessed the perfect asset class, not because you found a magic shortcut, because you built a system that fits reality, and reality rewards people who understand cause and effect. Stocks or real estate is not the real question. The real question is, what is the next responsible step in the system you are building? For most beginners, that step is stocks because they provide liquidity, smaller mistakes, faster feedback, and a direct path to competence. For many growing investors, the next step is real estate because it adds hard assets, tax advantages, leverage, and another stream of income. If done carefully, for mature investors, the answer is not either, or it is a balanced machine income, producing stocks, real estate, managed money. Cash and equivalents. Each part has a role. Each part reduces dependence on the others. Each part helps you survive different environments. And survival across environments is what lets compounding do its work. That is the principle. Start with what teaches you without destroying you. Move into what can scale once you are ready. Keep dry powder, respect liquidity. Do not mistake excitement for competence. And never forget that the best investors are not the ones who chase the loudest opportunity. They are the ones who build systems that keep working when the noise disappears.